Mousumi Singh Sengupta, and this program is supported by our departmental head, Dr. Ashit Kumar Mondol, and our governing body of THK Jain College. We are very glad to have uh, Dr. Shelly De Pondit, eminent educational personality among us, who is Assistant Professor and Head of the Department of Vijay Krishna Girls College. She will conduct this session, and before starting this session, I would like to state few words about our guest. Dr. Shelly De Pondit, having 16 years teaching experience in UG and PG level. She has been awarded her doctoral degree from Calcutta University, and now she is enlisted PhD supervisor under Calcutta University. She had successfully completed UGC minor research project and presented lot of paper and articles in different national and international journal. She has been honored as Best Paper Presenter in Second South Asia Conference on Multidisciplinary Research in the year 2019. On the occasion of centenary celebration of Department of Commerce, Calcutta University, her paper The Role of MSME in Indian Economy in New Normal was awarded as the best paper in the international webinar during February 2021, jointly with the Department of Commerce, University of Calcutta, and in collaboration with the Indian Accounting Association Kolkata branch and the Institute of Cost Accountant of India, supported by the London Overseas Centre of Cost Accountant. So before starting this session, at first I would request our principal to convey some words. Madam.
Thank you, Professor Choitali Pal, for your introduction. Are you able to hear me?
Yes, ma'am. Yes, ma'am. Okay. You are audible.
Yes. So, good morning and welcome, everyone. Now we are going to have a very enrichment topic that will be discussed in this today's solo lecture session. Now, I'd like to welcome our today's guest speaker, Dr. Shelly De Pondit, who is an assistant professor and head, Department of Commerce of Vijay Krishna Girls College, as Professor Choitali Pal has already mentioned. Welcome, madam, to our institution, to this event, but in the online platform. Later we'll expect, definitely you will be here, will be whenever we'll get chance, we'll be definitely will be called here, you will be invited here to meet our students and all of us, I mean in physical mode. Anyway, welcome and thanks, madam. Now it's really great opportunity for all of the students of first semester to listen to this the particular session which is based on their curriculum, and important topic will be discussed, as madam already mentioned. The topic of discussion, as you are aware, that it will be accounting to special sales transaction consignment. I think that is the topic of discussion for today's session.
Yes, ma'am.
Important thing, yes. I think it is the right time to have this kind of discussion, which will be very much fruitful, and all of the students of our semester students will definitely be benefited out of that. I'm really thankful to the organizer that who has taken this initiative and arranging this program. And one thing, syllabus is complete, and now students, you will be facing your first semester examination, and that will be the first examination in your when you have entered in the field of higher education, that is for your undergraduate become honors and general course. It's really a high time to take this exam seriously. That we don't have any other option basically to conduct this examination online mode, because it's in this current during this current pandemic situation. But one thing I want to mention, though there is enough opportunity of the using the various unfair means, like you have enough chance of consulting and copying from various source whenever you will be appearing from examination. Plus, please students, don't go for that. Please don't go for all these to adopt all these unfair means, because in that case you will be cheating yourself. You are in first semester, you are starting your careers in higher education, you are entering in the field of this higher education, you have planning for your further education in this field. And you will have to appear for different examinations, competitive examinations, and any other entrance examination, where there will be putting lot of weightage that will be given on your ability to understand, to analyze the subject, and how much knowledge you have gathered, your ability of problem solving, different points you will be assessed. So you have to take this examination very seriously, my dear students, and you have to take enough preparation to appear for the examination. So okay, I won't take much time because you will have some important discussion. And I am really thankful to Dr. Ashit Kumar Mondal, head Department of Commerce, and Professor Choitali Pal for taking the initiative of arranging this lecture, this seminar. And probably, and and all the topics, I think your syllabus is, I'm sure, not think, I'm very much sure that your syllabus is complete, and have your internal examinations from that will be comments from 2nd of February, and you have enough preparation for that. And I wish you all the best for your forthcoming examination. And I am once again I'm offering warm welcome to our guest teacher, guest madam, speaker madam today. Thank you very much.
Thank you, madam. Thank you, principal madam, for her valuable words. Now, I would request Dr. Shelly Depondit to conduct this session, and she will conduct this session for first semester students. And the topic of this session is accounting for special sales transaction consignment. Over to you, Shelly.
Thank you, Choitali. Am I audible?
Yes, yes, you are audible.
And whether my video is visible or not?
Yes, yes, you are visible.
Okay. So, a very good morning to everyone. Now, first of all, I want to thank Professor Moshumi Singh, principal of THK Jain College, Kolkata, and I convey my heartfelt gratitude to Professor Ashit Kumar Mondal, HOD, Department of Commerce of THK Jain College, and of course, I will very much thankful to Professor Choitali Pal, Assistant Professor of THK Jain College. Now, and a very good welcome, a warm welcome to my students who are here to learn something, though your syllabus has been already completed by your teachers. And what ma'am has already told you, that it is the right time to gather some knowledge, okay? Just giving a mere examination is not at all for every requirement that you need to have for your bright future or career. So you must have some knowledge in the field of accountancy, so that in the coming future you can do well in your career. And this is the first semester. You have another 5 semesters, so I think you will learn a lot of things in the field of accounting and finance, and after 10 years or 12 years you will enrich our society. So that is the main motto of teaching something to my students. You are my students, I'm from a different college, that is a different part, okay? But the thing is that end of the day you are the student, whether from this college or from my college. So this is a curriculum enrichment program for the students of BCom Honors and General under Cbcs. So without wasting any time, straight away we are going to the topic. So the topic that I have selected for this session is accounting for special sales transaction, and I have chosen the topic consignment. So please tell me, Joitali, that whether my screen is visible or not. Please tell me whether my screen is visible or not. Okay.
Okay. No, your screen is not visible. You are visible.
Yes. Now is it?
Yes. Now screen is visible.
Okay. So, and I'm going to start the slideshow. Whether it is visible, Joitali, the slides?
Yes, it is visible.
Okay, so once again, a very warm welcome to my beloved students and the teachers of this college. The topic is consignment, right? Now, let us start the concept of consignment. Basically, what is consignment? Suppose you are living in the city of Kolkata, you have some manufacturing concern, or you want to sell your products some other places in your country or abroad. Now there are some constraints to sell those products in the other area or the other country. So what to do? You will just appoint one agent. Okay, so the agent will sell your product. So this is the main concept of consignment. That means you will not necessary for you to go to the place. Suppose you are in Kolkata, want to sell your product in Mumbai, so do not need to go in Mumbai to sell your product. Just appoint one agent to sell your goods. So what is consignment? The introduction, the slide is itself given that it is a kind of business expansion without actually opening a branch in a new potential market, and selling of goods through agent. So this is the basic definition of consignment. Okay, one thing, student, it is purely a class, I think. So if you have any question, there are two methods. Either you can ask me at the end of this lecture, or you can write it in the chat box. Okay, so you can take any option. So now they're involved two persons in the total business of consignment. One is the consignor and another one is the consignee. So consignor is that particular person who is sending the goods, right? Suppose you are in Kolkata and sending the goods in Mumbai, so you are the consignor. And who is consignee? Of course, the party who receives the goods and entitles to receive commission at a stipulated rate on total sales. Now, what is this commission means? Suppose you are the consignee, you are not the owner of that particular goods, but you are selling the goods at another location. So what will be the return? What will be the yield? What will be the thing that you get to sell the goods of the other person? Nothing, but you will receive one commission, right? So this is basically the ordinary commission type of concept. So other commissions are also there, so I will come it later. Now, what is the role of consignee? Consignor is the owner. He is the owner of the goods. He will enjoy the profit. He has to bear the losses, etc., etc. But what is the role of consignee in this business? Actually, two roles. One is to market the product and to promote sales. So this is the thing. And let us come to the accounting part. So consignment account, in case of this chapter, we are going to open the consignment account. So this is a simple ledger accounts where we can write all the transactions related to the goods sent on consignment. Now, what is the economics of consignment? First of all, why do I need consignment thing? Okay, so I can open another branch in separate place, but to save the cost, we need consignment kind of business. And the second one is the manufacturer may not have the capacity to open branch while he intends to tap distant market. Now let us come to the sales and consignment. When the goods are sold by the consignor itself, it is termed as sales. Got my point? And when the goods are sold by the consignee, it is known as the consignment. So there are some differences in between these two. So we can go through this table to get the differences between sales and consignment. The number one is property in goods. So the property in goods in case of sales directly transfer to the buyer along with the transfer of goods. But in case of consignment, goods remain the property of the consignor until sold by the consignee. So this is the major difference. Now let us come to the unsold stock. In case of sale, goods once sold cannot be returned except in case of defective goods. But in case of consignment, we all know there may be some unsold goods, and who is the owner of that unsold goods? Simply the consignor. So that unsold goods are to be returned back to the consignor. Now come to the debtors. For credit sales, the buyer become the debtors in case of sale, and for consignment, the buyer become the debtors of the consignor. So that is the different things. In case of sale, who is the debtor? The buyer, of course. In case of consignment, who is the debtor? The buyer, of course. But debtors to whom? Debtors to seller in case of sale, and debtors in case of consignor in case of consignment. Now loss. Let us come to the last thing, that is the loss. When the goods are lost during the process of sale, and you think that the loss occurred after sending the goods to the buyer, then the buyer is solely responsible for that kind of losses. And in case of consignment, when goods are lost on consignment, the consignor itself is liable to bear the loss. Now, procedure of consignment transaction. So theoretical part, we have completed a certain portion of theoretical part. Let us come to the transaction process. So what is the thing? Suppose you are living in Kolkata, sending the goods to another place. At what means? At a means of pro forma invoice. So pro forma invoice is basically a document, okay, where we can show the invoice. But you should remember, it is not a demand for payment. It includes description of goods and minimum selling price to be realized. At the time of sending the goods, the consignor may have some expenses. What are those expenses? We all know. What are those expenses? I will come later. And now after receiving the goods, so you send the goods to Mumbai, your consignee will try to sell the goods, though he is not the mere debtor of the consignor. So the consignee may have some expenses towards consignment, and it is the duty of the consignee to remit the proceeds of sales after deducting his or her commission and expenses to the consignor. Now, let us come to the diagram, right? So here the diagram shows the entire picture, or that it is a pictorial presentation of the consignment. So I think B should be below the partner. Okay, anyways, let us come to the point. So A of Kolkata sent goods to partner, and at the time of sending the goods, he may have some expenses. And I think this slide is no, this is not a proper slide. Let us come to just the theoretical portion that A of Kolkata sent some goods to B of partner by incurring some expenses, and that expenses can be loading, carriage, and insurance. So you come to the, you just forget the non-recurring what has been written in this slide. So the loading, carriage, and insurance are the basic expenses borne by the consignor while sending the goods from one place to another. And the consignee will receive the goods, and he may have some expenses like unloading, carriage, go down, and selling expenses. Now come to the in-between fact. What is the in-between fact? That at the time of sending some good, there is always a chance of loss. Okay, the loss can be happened by a fire, any accident, or such kind of thing. So that loss, you must consider that loss while sending the goods from one place to another. Now let us come to the expenses of the consignee. Please go through the slide. Two expenses are given as unloading and carriage. Got my point? And another two just below the carriage is written as go down rent and selling expenses. Now let us think about the nature of such expenses. You think about unloading and carriage. These two expenses are one-time expenses. That means when consignor sends some goods to consignee for one time, we assume that for one time the consignee has to bear the unloading charges as well as the carriage charges. So this kind of expenses, that is one-time expenses, are known as non-recurring expenses, called the non-recurring expenses. Come to the next two, that is the go down rent and selling expenses. So if in the market in some place, that is known as go down, and if you do not have your own go down, in that case you have to pay off the rent to the go down owner, and that is the recurring kind of thing, the recurring kind of expenses, because to that ordinary commission is nothing but on the basis of sale the consignee will receive such kind of commission. There are two different kind of commissions. One is del creditor and another one is the special commission. Let us come to one after one. Okay, let us concentrate on the loss of goods on consignment and their accounting treatment. Like any losses in the consignment, losses are of two types. One is what? Normal losses, and another one is abnormal losses. Now, what is normal loss? Normal means it is unavoidable, inevitable. You cannot avoid this kind of losses, right? So in the course of consignment, and it will arise due to leakage, evaporation, drying, etc. So what is the treatment of normal loss in case of consignment? First of all, you should ignore the loss. What is the meaning of that? That value of remaining stock absorbs the loss. Okay. Therefore, no accounting treatment is necessary. But remember, if there is no unsold stock. Got my point? If there is no unsold stock, no accounting adjustment or treatment is necessary. Now, if there is any unsold stock, in that case, what to do? You have to deduct the unit of normal loss from net quantity of goods received to get the unit of unsold stock. Now, here you concentrate on the phrase net quantity of goods received. What is the meaning of that? Net quantity means, suppose take one example. You sent 100 goods from Kolkata to Mumbai and 10 goods were lost during transit. So we assume all goods are okay. So the consignee will receive 90 goods. So that 90 goods are termed as net quantity of goods received by the consignee. Got my point? And from that, you have to deduct the unit of normal loss and sell to get the units of unsold stock. So that is the only treatment of normal loss in case of consignment. But you should remember, if there is unsold stock, in that case only we have to deduct it. Otherwise, no accounting treatment is required. Let us come to the abnormal loss. So it is just the reverse of the normal loss. It can be avoidable. If you take a good means of protection, you can protect fire or theft. So if you have a good security, you can protect the theft, etc. Okay, so it is avoidable and arises due to the theft, fire, etc. and occurs either in transit or at the consignee's place. So what is the meaning of either in transit? When you send some goods from Kolkata to Mumbai, so on the way there may be some accident. So that in transit accident is called as abnormal loss. Got my point? But after receiving such goods by the consignee, there may be some losses at the consignee's go down. That is why abnormal losses can happen in two places. One during transit and another one at the consignee's place. So what is the treatment of abnormal loss? First of all, it should be valued. You have to value the abnormal loss, and the amount of abnormal loss is to be transferred to a special account called as abnormal loss account. So this is the treatment of abnormal loss, and we all know. Let us come to the valuation of abnormal loss after that, and how to value the abnormal loss. So the cost price of the goods sent, okay, cost price means, suppose in our example 100 goods were sent for rupees 10. So 1000 is the cost price of the goods sent. So we add non-recurring expenses up to the point of loss. Here, what is the meaning of non-recurring? That is one-time expenses. And you should remember that non-recurring expenses of the consignors as well as consignee, you have to sum up all these figures. Now, by adding up the cost price of the goods sent and non-recurring expenses, you will get divided by total quantity multiplied by quantity lost. Quantity lost means in our case 10 goods were lost. Remember, so we sent 100 quantity, and what is the total cost? 1000. Suppose assume that no cost was incurred by the consignor. Just take one straight example, a very simple example, that the total cost of the product is say 1000. Total quantity sent, say 100 units, and quantity lost is say 10 units. So by putting all these figures in this formula, we will get the value of abnormal loss. Now let us come to the value of unsold stock. So this is the valuation of unsold stock. So there are actually 4 steps to finding out the unsold stock. So what are those? First thing, cost price of the goods sent, just like the valuation of abnormal loss. Then you add non-recurring expenses of the consignor. Okay, so non-recurring expenses of the consignor, that means this two, the summation of these two will actually reflect total cost just before the loss in transit. Got my point? Just before the loss. That means you send some goods, you incur some expenses, you add these two figures to get the position just before the loss in transit. Now, what is the second step? The step is that you have to deduct the value of loss in transit, if any. You can find out in the previous step how to value the abnormal loss. Got my point? Now, the total cost just after the loss in transit you will get from here by deducting the loss in transit. That is by deducting the abnormal loss. Now, let us come to the next one. That is, you have to add the non-recurring expenses of the consignor. Okay, so the non-recurring, what are the non-recurring? Just you remember that carriage and that unloading part. And you shouldn't take the selling expenses and the go down rate because these are recurring in nature. Now the question arises, ma'am, why should I take only the non-recurring expenses? And why shouldn't I take the recurring expenses? That is I think this is a very important question, right? So the answer is that what is the aim of this business? Just to sell the goods and to earn the profit, right? So this is the aim. Now, what is the aim of the consignor and the consignee? To make the goods sellable in the market. So what are the expenses that are needed to make the goods sellable in the market? Only sending the goods, giving some insurance charges, have some carriage, have some freight from the part of the consignor, right? And from the part of the consignee, there may be some unloading charges, some sending charges, some carriage. These are required to make the goods sellable in the market. But you think about the other two, that is the go down rent and selling expenses. This is directly related to sales because you don't know when will you are able to sell the goods in the market. Maybe after 6 months, maybe after 1 year. So for the 6 months or for the 1 year, you have to bear the go down rent. So you don't know what will be the actual expenses for the go down rent. You do not know what is the selling expenses. Maybe it will be increase from the present time, right? Maybe maybe government may change some rules. That is before just 1 year. You just remember what was the carry bag? Simple plastic bag. But nowadays, what is the nature of the carry bag? carryback is actually jute made carryback or any other things, and you have to pay off the money, 20 rupees, even 15 rupees you have to pay off to get that carryback. So you don't know what will happen in case of the selling expenses, but what already occurred, that is your carriage, your unloading charges, you know, all those expenses. So that is why we are not taking the recurring expenses and concentrated only on the non-recurring part. I think it is clear to you this part. So after adding the non-recurring expenses, what you have? The total cost in the hand of the consignor. And let us put one formula. What is the formula? Simple. Total cost in the hands of the consignee, you get it from the previous adjustment. Net quantity after abnormal loss. We understood what is the meaning of net quantity. Just remember, you sent 100 goods. The loss, the in-transit loss is 10 in case of our example. So 90 is the net quantity after normal loss. And if there is any normal loss, say, just take one example, that is 5 is the normal loss. So 100 minus 10 minus 5, what remains? 85 is the net quantity after abnormal loss. And quantity of unsold stock, suppose, let us assume it can be anything. Unsold stock maybe 2, 3, 4, depending on the sum. So you have to just multiply. But what you remember, that the net quantity after normal loss. So please remember the formula, the net quantity after normal loss, unit sent minus unit of abnormal loss minus unit of normal loss. Okay, so let us come to have some commission. Okay, in lieu of selling of the goods of the on behalf of the consignor, right? So what are the different types of commissions? 3, you already know. One is the ordinary. What is ordinary commission? Just it is, you have to calculate it on the total sales. Percentage is given in the sum. So it is written as a stipulated rate. So it is predetermined that you will enjoy 10% of profit on cost, etc., sales, etc., etc. Let us come to the second one. That is the most important. So Dale Credier commission. Okay. So the consignor actually tells the consignee to sell the goods, but in which mode? On cash, on credit. It is not described in the contract. So in case of that part, the consignee can anytime sell the goods on credit. And we all understood that if there is any credit sale, there is a chance to have some bad debt. Okay, now the question is, who is responsible for such bad debt? That is the question. Okay, so in general, it will come to our mind that the consignor itself is responsible for such bad debt. The answer is very simple, that he is the owner of the goods. It is his goods, so he is responsible. Okay, absolutely right. The consignor is responsible for the bad debt. But in case of the consignment, he or she is not going to pay off the amount of bad debt or not to bear the burden of bad debt. So in that case, what will she or he do? Simply pay off another or different kind of commission to the consignee. Got my point? And that commission, that different additional commission, is known as the Dale Credier commission. Now the question arises, ma'am, the consignee is enjoying an ordinary commission, and on that he is again enjoying a different kind of commission, that is Dale Credier. Why? Because if the consignor pays off the Dale Credier commission, now if bad debt occurs during the course of the consignment, so the consignee will solely responsible for such bad debt, because he is already enjoying an additional commission, namely Dale Credier commission. Got my point? So consignor actually pays off Dale Credier commission to consignee to minimize, or to just, you say, to erase, to eradicate the burden of bad debt. And in such case, if the Dale Credier commission is given, the consignee is solely responsible for such bad debt. Okay, so basically, if you think about from the side of the consignor, del creditor commission, it is nothing but a form of credit insurance. Okay, it's just a credit insurance, and it is of course a percentage on the gross sales, or there may be some separate agreement. In different sums, you will get that only on the credit sales. The del creditor commission you have to calculate, so it will depend on the agreement, but in general sum, what we will find that it is a predetermined rate, just like the ordinary commission rate. And let us come to the third one, that is the special commission. So name itself told you that it is a special kind of thing. So mainly it is calculated on additional selling price, okay, at per predetermined percentage or separate agreement. Now what is the meaning of additional selling price here? Suppose your consignor, you are the consignee, you just think your consignor told you to sell the goods, say example for rupees 200, but you are able seller, you are a very good seller, you can sell out that goods for rupees 250. Got my point? So the given selling price is 200 and you sold out that goods for 250, so that difference of 50 is the additional selling price, and on that additional selling price you are going to get a predetermined profit. This kind of, not profit, predetermined kind of commission, percentage of commission, and that commission is known as the special commission. Particular, so basically on that 50, so 50 into number of goods sold at a higher price. Got my point? So this is the special commission. So these are the three commissions that we found in consignment. Now there are some different kind of transactions in the consignment, and one is the treatment of advance made by the consignee. Advance, that means the consignee paid some advances to the consignor. Got my point? Before selling. One thing you should remember, that advance means just before selling, or even it can be before receiving the goods from the side of the consignor, the advance. So what? That